This is our Forex blog for March 6, 2013. And for the last 6 or 7 years, we pretty much focus on just using our currency meters to find the statistically strongest currencies to buy versus a week. Now we also have indexes that also statistically compare every dollar pair, every yen pair, every pound pair, every euro pair. And we basically turn it into a chart where you can see the previous day's high-low, you can spot double bottoms, double tops, you can draw fibs on it, you can draw trend lines on it, you can, in this case of the pound, you can see it was going sideways for many hours, it broke down underneath yesterday's low, and then when it came up and retested yesterday's low, support levels once broken tend to become resistance. That's true with all markets, whether it's stocks, futures, gold, Forex, bonds, any market. That's pretty much the same as it is with our synthetic, in this case, pound index. So what a high probability place to sell when it came back up to the previous day's high and the hourly moving average of that index. So in other words, at 6:30, you know that the pound pairs are likely to be going down, and you want to trade it against one of the stronger ones. Well, the yen's just kind of going sideways, and it's near yesterday's low, so that's not very strong. The euro is certainly stronger than that, but coming up to 6, it's also underneath the hourly. And the dollar's been trending up and then going sideways. So more than likely, at this 6:30 area right here, one of the higher probability trades that you could take is looking for pound dollar sell. And you can use any time frame chart to plot this on, whether it's a 2-minute chart, 5-minute chart. If you notice that chart at 6:30, you have a pullback right here. And notice, a lot of times I will kind of wait for trend lines to be broken to get in. And the trade didn't go your way immediately. You put your stop right above the swing high by a pip or two, and you're literally risking less than 10 pips. And when it goes sideways right here, you might, after a while, get out of that trade with 3 to 5 pips profit, get short again, get out here when it double bottoms at the low, look to sell again after a pullback here, and vice versa. And again, you can use 5-minute charts, 15-minute charts, 30-minute charts, 5 pips per bar range charts, or whatever you find is helpful. And there's many ways to get out. You can use support resistance. You can put a chandelier trailing stop on it, and just get out. You're short out with about 25 pips, short again, out with 10, 20, 25, 30 pips, short again here, you lose 8 pips, short again here, you made 20 pips. Not every trade's going to be a winner, but when you are trading strongest currencies like the dollar against the weakest, you have these wonderful trends. Now, the yen was pretty much going sideways, so the pound yen very likely was going down too. But you can see it's just kind of, making a very tiny move down, 10, 20 pips, versus probably about a 50 or 60 pip move with the pound dollar. Let's find some other currencies that might have been weak, such as the Swiss. It's going sideways, broke down underneath yesterday's low. Notice once it trended down, it came back up to the hourly moving average at 7:30. So this is a weak currency. The dollar was clearly the strongest of the top 4 individual currencies we look at, and so the dollar Swiss is one that you want to be buying. And as you can see, especially when the Swiss broke from above to below the previous day's low, right around 3, look what happened on this chart at 3. Nice little 10 pip move, you have a nice little sideways move, pulled up another 20 pips, you got another pullback, you might have made 10, 15 pips here, another pullback, 20, 25 pip move, pullback, you might have got out of that break even, you got in again here, you made 10 pips, and it's that simple. And another thing you can use to not only time your entries but also maximize your profits is our new perfect oscillator. It's a perfect oscillator because there's 0 lag on this, and it doesn't use a period, which causes all kinds of problems. MACD, stochastics, they'll look back over 9 to 14 of the previous bars. That's what the period is. And if there's a big move 14 bars ago, when there's a new bar, that 14 bars ago bar now becomes 15 bars ago, and it falls off the end, and it no longer has an impact on the oscillator, and it causes big jumps of the oscillator when possibly no current movement is even happening. And so that's one of the reasons why oscillators are horrible. They use a number of bars back to analyze. Ours doesn't use that. It analyzes each bar as an independent thing, and it's all based on statistics. So when you add this to your chart, the 80 level tends to be when the markets have gone too far, and you're likely to get a reversal. They're good places to get out with a profit. Notice it pulled back and went sideways for an hour, and then at this point right here, it went up a little bit more, but pretty much went sideways and then down over the next couple hours. Notice this area right here. That was the end of the move, and it pulled back for 40 minutes. So these are excellent ways of knowing not only to use it to time to get in, but also to maximize your profits. I've drawn a moving average of this perfect oscillator and Bollinger Bands as well. And a lot of times when the market explodes up and you see a lot of strength, when it comes down to the zero line or the lower Bollinger Band, which is both in this case, it's usually a decent place to be looking for buys. And it allows you to wait for what I consider to be a more perfect entry time and entry price, and that's why I call it the perfect oscillator. There's no drawbacks based on what other indicators do, and it really helps you pinpoint exact timing. So at this point, you're looking to buy. You might want to get in on that bar here when above that bar's high. You're stop underneath the low, and it took it about 20 minutes, and then it shot up. Guess what? It's at an extreme here, so you might want to tighten your stop, get out. Here is another pullback. You might have got into a trade here and maybe had a small loss. You got a little bit deeper pullback. And you can also use what I like to call divergence trading, where you either have a double bottom and the oscillator has a higher low than before. You can see a low, higher low, higher low. This is a major reversal sign to the upside. And it also helps you spot highs most of the time too. Explosive high, slightly higher, lower high, lower high. When you see a strong trend like this and you want to start to look for counter trend trades, you can see this one wasn't even able to hit the upper Bollinger Band, and you got a nice 8 or 10 pip pullback right here between 10 and 11. Now if you had this on a 3, 4, or 5 pips per bar chart, it would have definitely improved your timing. So let's take a look at the dollar Swiss. Doesn't move as much as the pound dollar and euro dollar. So let's go to maybe a 4 pips per bar chart. When we're looking to possibly do a counter trend trade up here near the high, when you see a double top up here, you can obviously go short. You never know how many pips you're going to make, but you can see it went down, 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 and wicks at the low of range bars tend to be reversal signs, so you might have got out if it went a pip above this bar's high right here at 60. You're short around 64, so you really didn't make much on that counter trend trade, but most traders aren't able to make any money at all trading counter trend. So let's take a look at some of the other currencies here. Event-based trading, I consider when a currency actually does something of value that's likely to cause a trend. In this case, when a trend line gets broken, you can see it came up, it's chopping around, it's underneath the point of control, which is the price. Most traders have positions in all the CAD pairs. Underneath that, it's more likely to go down. Above it, more likely to go up. Underneath the hourly, it's more likely to go down. And when it broke down right here, made new lows and broke yesterday's low here at 7, very high probability place to be selling the CAD. So one of the stronger ones, as we know, was the dollar. So we're looking to buy the dollar CAD at that time. Let's see what the exact time was. The first breakdown was at 7, the second one was at 10. So we're looking to buy this. You can see this one was coming up to the high. Notice on the perfect oscillator, both here and here, it hit my lower band. And anytime you have a down bar followed by an up bar, when it's at the lower band and the trend's up, you buy it when it goes 1 pip over that bar's high. And you can put your stop right underneath the low. So you're literally risking 4 or 5 pips in this trade, and you can see it shot up about 12 pips. And notice again, the perfect oscillator is showing an extreme up move right here. And so for short-term traders, just move your stop up a few pips underneath the bar's low. I typically will walk it up. This is kind of a reversal sign when there's a wick and there's barely a higher close. And you can see you can get out here, or you can let the trailing stop get hit. The second time we got a pullback. You can see the market made a lower low, but the oscillator made slightly higher low. That's a sign of the downward momentum, which started off pretty intense, and then it was slowing down. This is a pretty good place to be buying. And again, as it goes up, anytime it's over the extreme level, it can continue. So you might want to exit half your trade and put your stop underneath the bar's low, yank it up a little bit more. You would have been out of this somewhere near 20, and you would have been in this trade even before the explosive move at 76. So that's about a 46 pip move right there. And again, if you want to do a counter trend trade when the market's at an extreme, you certainly can. Typically when it pulls back and hits the lower Bollinger Band, you might get some resistance. So at this point you're starting to watch it like a hawk. You always want to put your stop, if you're short, right above the bar's high and trail it down, because sometimes, like you can see here, you can catch a little bit more on the downside, when you're short. And you can see right here it hit the lower extreme, as did here, and the market kind of went up sideways and then reversed up again. So the minus 80 level is an extreme. Because the trend is up, you might want to even consider starting to buy when it breaks out. So you've been in this trade right here. Guess what? It hit the upper extreme here. At this time of the day, the market doesn't move that much. So you can hit the extremes a lot faster during dead times than during high volatility times. And this tool is very statistical in nature. At this point, it says this market's gone up too much at this time of the day, and guess what? It's done. It went sideways. So that's why I call it the perfect oscillator, because it's based on each currency's volatility for different times of the day. During the more volatile times, it reflects that. During dead times, it also reflects that. There's no lag, and with the Bollinger Bands and the plus 80 and minus 80 levels, tremendously helpful in not only timing when to get in, but also to let you know when not to be greedy. If it's at a plus 80 level and you're up 30 pips on the long, well, guess what? You're probably not going to make more than another 5 to 15 max. So watch it like a hawk up at the extremes, and don't give back your profits.